Profusa, Inc. NASDAQ, PFSA, Comprehensive Investment Report Executive Summary and Investment Thesis Core Business. Overview: Profusa is a digital health medical device company developing minimally invasive biointegrated sensors, filaments that continuously monitor biochemical markers in tissue, such as tissue oxygenation, Lumi-oxygen platform, and in future glucose. Other analytes. The goal is to provide clinical-grade continuous biomarker data for disease monitoring, wound care, chronic conditions, etc. Investment recommendation: 12-month view, sell/high-risk bull case. Unique technology: Profusa's sensor approach, biointegrated, potentially long-term in tissue, has novelty, as frequent replacements compared to some competitor sensors could be attractive. Regulatory commercial milestones on the near horizon: CE mark in Europe for oxygen monitoring, potential distributor partnerships, and planned U.S. regulatory progress. As successful, these could unlock meaningful revenues. Recent capital raises, financial facility: Profusa has secured financing and an ELOC equity line of credit to support development. This gives some runway. Bear case: almost nil commercial revenue. Company remains pre-commercial, burning cash on R&D and operations. Massive losses relative to tiny revenues. Free cash flow heavily negative. Regulatory risk is substantial. Device approvals, validation, clinical data, safety, reimbursement are long, uncertain, and expensive. Competitive risk: established players in continuous glucose monitoring and other biomarkers dominate. Switching costs for medical users and providers are high. Final recommendation: sell or speculative hold for those with high risk tolerance. Given the risk profile and near-term lack of revenue, for most institutional investors, the risk-return doesn't favor a buy. Only very speculative investors with long time horizons might consider small exposure, conditional on regulatory milestones. Current price context: last known revenue, $75,000 TTM. Losses of approx. 9.8 million United States dollars over TTM. Basic EPS, $1.75. Market cap, small tens of millions. Valuation multiples are extreme, undefined, due to negative earnings and near zero revenue. Business overview: operations and key products, services. Current flagship is the Lumi-oxygen platform, intended to measure tissue oxygen in applications like chronic wounds, peripheral artery disease, reconstructive surgery. Also developing a Lumi glucose platform for continuous glucose monitoring. The company also participates in research-use-only orders/collaborations. Business segments and markets: primarily R&D, clinical validation stage, pre-commercial. Geographically operating from U.S., planning European launch, CE mark with future U.S. regulatory paths. Primary customers: use cases, hospitals, clinicians, managing wounds, vascular disease, research institutions, possibly eventually individual patients, consumers for glucose, if regulatory approval. Industry and competitive positioning: industry landscape. Medical sensors, continuous biomarker monitoring is a fast-growing field, spurred by demands for better wound care, chronic disease management, and remote monitoring. However, it is highly regulated with long approval cycles, high standards for safety, reliability, calibration, reimbursement. Growth drivers: aging populations, incidence of diabetes, chronic wounds, peripheral artery disease. Demand for real-time health monitoring, telemedicine, home health platforms. Improvements in material science, AI/ML, to interpret continuous data. Headwinds: regulatory clinical validation requirements, proof of safety, stability of signal over time. Reimbursement: payer acceptance is often slow and unpredictable. Competition from entrenched players, Dexcom, Abbott, Medtronic, etc., especially in glucose monitoring. Manufacturing scale, sensor reliability, sensor drift, biocompatibility issues are technical risks. Competitive moat and position versus peers. Profusa's moat is its biointegrated sensor filament design, plus ambition to measure non-glucose biomarkers, oxygen, etc. The approach may have advantage if reliability and implantation integration issues are solved. But pure advantage for incumbents, existing installed base, Regulatory experience, brand, manufacturing scale, reimbursement relationships. Profusa is far behind them in those respects. Financial analysis. Below are trend snapshot data pulled from latest public sources. Again, verify via recent 10Q, 10K metric TTM, latest mid-2025. Prior periods commentary revenue tilde. $0.08 million approximately equals 75,000 United States dollars. Low, essentially non-commercial revenue. Prior year was slightly lower. Revenue growth percent looks large in percent terms, but from tiny base. Revenue growth YoY tilde plus 60 to 120% from prior period, but from negligible base. Gross profit tilde equal to revenue tilde, $0.08 million. So gross margin, approximately 100%. Since cost of goods is effectively zero for what is revenue. Not meaningful for scalability. Operating expense $4.60, $5 million in recent periods. R&D plus SG&A are large. Net income loss, TTM net loss, approx 9.8 million United States dollars. EPS, approx $1.75 per share. EBITDA not publicly meaningful negative. Financial health and key ratios, free cash flow tilde. 2.18 million United States dollars TTM. Company is burning cash. Current ratio liquidity, very poor. Very small cash reserves cash tilde, $44,000. Large liabilities relative. Debt equity, book equity is negative, i.e. liabilities exceed assets, making debt equity not meaningful. Return on equity row, not applicable / negative. Very poor. Efficiency metrics. Revenue per employee is low, given very small revenue base. Other metrics like inventory turnover, receivables, days, etc. are not meaningful for this stage. Valuation, because Profusa is pre-commercial, with negative earnings, minimal revenue, and large losses. Typical valuation multiples are of limited utility. Still, some comparisons. Valuation metric Profusa PFSA. Latest TTM peer industry benchmarks. Comments, commentary. PE trailing. Not applicable undefined net loss. Peers when profitable often have PE in double digits 22-34, high-growth medtech firms trailing earnings negative. So PE is NA, forward PE not available, speculative some medtech growth companies forecast positive earnings in few years. Forward multiples can be high 30100 depending on growth high risk. PS price/sales, very high PS based on negligible revenue. PS ratio is astronomical or meaningless given tiny denominator. Peers might trade at PS of 5 to 20, depending on growth in recurring revenue. Investors are discounting heavily because revenue is not yet material. EBITDA, MEBITDA, negative/undefined, since EBITDA is negative for peers with positive EBITDA. Multiples might be 10 to 20 or more not usable until profitability improves. Dividend yield none. Most early-stage medtech don't pay dividend. Peer dividends rare in this kind of company. No yield. Valuation rationale. Profusa trades more on future potential regulatory approvals, clinical data, commercialization, rather than present financials. The risk premium is very high. Risk assessment key risks. Regulatory risk, needs CE mark, FDA clearance, or equivalent for both oxygen sensor and glucose sensor. Clinical trials often slow, costly, can fail. Commercialization risk. Even with approval, moving from pilot research use to full clinical adoption and reimbursement is hard. Scaling, manufacturing, ensuring reliability, integration into clinical workflows all pose risks. Financial risk. Cash burn. Current losses and negative cash flow mean the company must rely on funding equity, lines of credit. To survive till commercial revenue ramps, risk of dilutive financing. Competitive risk. Mature CGM biomarker monitoring players already have IP brand. Regulatory experience. Profusa is late to many of the spaces. Technology operational risk. Sensor stability, drift, patient safety, biocompatibility, signal accuracy, all technical challenges. Market adoption and reimbursement risk. Even after approval. Getting payers and providers to adopt, including convincing use cases, cost benefit. integration with existing health tech, etc. Upcoming catalysts to watch: European commercial launch of Lumi, Oxygen platform CE mark expected around Q1 2026, U.S. regulatory submission for Oxygen platform FDA, projected mid-2026, progress readouts on glucose platform clinical trials, possibly starting in 2026, distribution partnerships in Europe, Spain already mentioned, and other countries, funding or financing developments, cash flow milestones. Conclusion. Recommendation. Sell for most investors, high risk. Very speculative for those with high tolerance. Top supporting points: bear greater than bull. Profusa's current financials are very weak. Minimal revenue. Large losses, negative free cash flow, negative equity. Regulatory and commercialization timelines are long. Many things can delay or fail. Valuation is high in risk terms. Price reflects speculative hope rather than current operating substance. What could move the needle? Bull triggers. If the Lumi Oxygen platform gets successful CE mark commercialization with real revenue in Europe in 2026. If clinical trial data for the glucose platform is positive and regulatory path in US becomes credible, path to profitability becomes visible, i.e. costs under control, margins improving, recurring revenue, critical risks to monitor: cash runway, how long until more capital needed, and what terms. Regulatory setbacks, failures. Competitive moves by incumbents, Dexcom, Abbott, Medtronic, etc. Quality safety issues,